I appear to have the sound working, so this is part two of our financial statement analysis. You probably can't take the whole thing. So this is more, how does an asset get onto the balance sheet? It's all that simple stuff we did, what's an impairment, what makes an asset, what makes a liability. Okay. I say, remember when I did that really simple example? You start with the balance sheet date. Remember, a balance sheet has a point in time. It has a point in time. Okay? A profit and loss statement, income statement in the U.S., cash flow statement has a period. So we're going to take that point in time, start it, and get an ending value. So asset can increase. Well, cash goes up. Accounts receivable turns into cash. That's why it's supposedly an asset. I have this accounts receivable, I suppose, because these people don't pay me. I'm such an idiot with my business, really. God, still work for them. They didn't pay me. The asset goes down. If then that's a loss. If it's depreciated, or it could be sold for cash. It's just transferring one asset to another, really. So how does an asset go down and up? We either make some profit or we transfer it out of ourselves to go down. To go up, loss is to going down. Up, you make a profit or you spend some money to get it. Asset, gross plant goes up by capex and retirement. And we have to be so careful about retirements, and this feeds straight into the financial modeling analysis. Accounts receivable goes up when you record some income, but it goes down when you get your cash. It's like I guess it's just transferring the asset from one to another. Same with inventory. Inventory, what happened in 2008, these inventories shot up all the time because all these companies made the purchases, capex, and then they couldn't convert them. They couldn't make them into income. That was a horrible explanation. Okay, so accounts receivable. This is so simple, I guess, but if it goes up, that means so that it started at 100, went to 200. That means we booked more than we collected. And if we have revenues, that means we collected 900. Okay, I think you can work through that. Whenever you're comparing a balance sheet and an income statement, you should use the average because you got points in time. Value line doesn't do that, by the way. Idiots. Inventories, it's the same kind of thing. Okay, so I just said here's the connection between the balance sheet and the income statement. What this is capex. This is kind of the simple example, but it's showing how, for what happens to the capex. You take the expenditures from the cash flow statement. If we have a sale of assets, we take them away. If we have an impairment, it makes it go down. The depreciation makes it go down, and that's how we get our closing balance. Okay, assets. That's when you find the future balance of whatever. Notes receivable and accounts receivable. Here's the biggest deal for finance. Notes receivable are like cash. Any other, whatever they call it, marketable securities, they're like cash. They have nothing to do with core operations. So when you associate these things with EBITDA, you got to split it all up. I think that's a key thing. So what did I do here? A very really simple example of accounts receivable. We make sales of 100. We have 30 days. That means we take 30 divided by 365 and get 8% of the year. That means we don't collect about 8 out of our 100. Our cash flow isn't 100. Our cash flow is what we collect. And you could do the cash flow by saying, here's what your accounts receivable was. No, here's your revenues, and do your change in working capital. I was trying to explain change in working capital. But that's not how it really works. Accounts receivable, if you have a corporation, they never go down until you die. And corporations are not supposed to die. That's what I said in the first thing. Okay, so in this case, we just have our 100. It continues. You always collect it. You always transfer it, and it just the cash flow starts a little bit low and reflects the change. And if you have growth, it gets even worse. The accounts receivable always go up. It never just, you never sell the accounts receivable really. It just keeps going up and up and up. It's kind of like CapEx. You have to use this. You have to make a CapEx to grow the accounts receivable change to go to the company. I should be better at this. I should be able to explain this even more. These basic concepts, it's harder than hell to explain sometimes. So working capital changes are, like CapEx, I guess. I said it's like CapEx. And they're a reduction in cash flow. And here I have another example. So if you want to work through this or even take this exam, you can take my little exam. And if you pass it, I'll give you a certificate. And I'll charge you €1,000 for that. And then you can say you've got a certificate. I'm not really serious about that. That's what the fraud of the world is, though. Okay, God, these poor young people, I feel so horrible for you. You gotta take all these silly things. And then this is kind of in the notes. You can see that they start at the beginning balance. They see how it goes up and how it goes down, and they show the closing balance of an asset. And it goes up and down from just like we did in the very first thing. Now for depreciation, that's much more interesting, I think. The first thing to note is the retirements occur, if this is a 5-year life, 5 years after. I use the offset function to do that all the time. And retirements also reduce accumulated depreciation. And if you have flat CapEx, you can easily show the CapEx and depreciation are the same, and they stabilize. In this case, the net plant stabilized at 300. The CapEx and the depreciation are the same. Okay. If there's growth, then the CapEx are always going up. It still stabilizes, but it stabilizes a certain percentage. I've got a lot of other videos on that. And getting confused on depreciation, I don't think anybody gets depreciation right, probably including me, certainly including me, in financial models. And you can get big errors in them. Well, big, but you can get errors in valuation. Now, assets can come in from merger and acquisition. Here's the way a M&A works, and you shouldn't be intimidated by the accounting. Basically, you start with a company with a balance sheet, and most of the time we're going to pay more than the book value of the assets. This has nothing to do with market to book ratio. Yeah, it's market to book, nothing to do with premium, rather. So we pay 5 times the equity of the company, and then we take all of these assets and revalue the assets, and you put intellectual property rights, and then the balance here is goodwill. So if you really want to see what's going on, this equity goes away. There's a big X in this equity, and it's replaced by how much equity you contribute in the... It's not consideration, it's how much equity you contribute. And you should understand that if you're doing that. And if you look at this is Samsung again, if you look at their financial statement, all of these things, goodwill, development costs, well, not development costs, membership, goodwill, it all comes from, all this stuff that's going to get amortized comes from acquisition. The impairment of an asset. Now, the impairment of an asset, that's when... sorry about sniffling. The impairment of an asset, that's when you decide the assets get changed. And it's a big deal. Here's why it's such a big deal. One company impairs the asset, the other doesn't. We said we should make all these adjustments in EBITDA for exploration and all that. When you have impairment, it really has an effect on the debt to capital ratio. It has a big effect on the ROE, ROIC. It has an effect. And you can't compare that. You can't go and look at a trend and say, oh, here's this company and it's doing really well. Well, the reason it did well is last year it had a kitchen sink quarter and it wrote off all its assets, and its assets are low. So if take the EBITDA or no PAT, whatever the hell it's called, divide that by the assets and you get a bigger number after a write-off. So let's talk about impairment and goodwill and all this crap. Okay, this is what that Chesapeake did. It had a big impairment, and I just wanted to show that the assets go down when you have an impairment. Okay, and when you do this impairment, here's Samsung in their financial statements. They show you all the little ways in which they compute these impairments. Okay, and then I really wanted everybody to do a little exercise in my little exam that I have no idea how it works. But you're supposed to show, well, if you're taking the goodwill or whatever, these intangible assets, just like our CapEx, they go down with the impairments. Remember, assets go down with a loss or a transfer, up with a profit or buying the asset. You buy the intangible assets when you buy a company. It goes down with impairment, or, well, goodwill does it. And this is showing how we have two companies, one with no impairment, one with an impairment. The one with the impairment got a higher debt-to-capital ratio because the equity went down. Okay, and let's talk about liabilities a little. Okay, and the big thing for me with liabilities is figuring out what's net debt and start to talk about how you make this adjustment on the balance sheet, or in your analysis, you make the adjustment for which items are related to EBITDA and which are not. Debt is financing. Trade and payables, that's part of the EBITDA. If you change your supply, whatever, your arrangements with suppliers, they're probably going to charge you a different price. And if they charge you a different price, if they charge you a higher price because you're going to say, I want to pay you 3 years from there, they said, okay, we'll charge you a higher price. Then the EBITDA goes down because that's purchases. So that's related to EBITDA, some are not. What do we do with deferred taxes? Oh, shoot. What do we do with all this other stuff? Provisions. Provisions, I never know how they are. Well, a lot of those are just like warranties. So here's what I kept on telling. Don't be afraid to read the details of a balance sheet. Okay, so what is debt? This is, this is Standard & Poor's, I should have said. Our depiction of these transactions as debt, which is often contrary to how a company reports them, affects not only quantification. Oh, God. Net debt, here's what we're going to do. We're going to find out what's the real core operations of the company. Okay, and in the core operations, we're going to look and see how much is, if there's cash, we call that negative debt. Say, oh, we got a bunch of cash, we could pay back all the debt. You could also take a vacation, holiday. You could also bribe people. You could pay yourself a bigger salary. You can do a whole lot of things with cash. If you have children or sisters, you know what they do when they get a hold of it. Okay, and here, why don't we call accounts payable debt? What a simple question. Anybody who's in finance says, oh, that's obvious. It's not so damn obvious. It's supposedly got to repay the accounts payable just like you repay all the debt. First thing we can do is the same sort of thing. Say this accounts payable never goes down as we grow the company. And it's debt that never gets paid. But you can say that about other debt too, because debt always gets refinanced. I think the answer has to be that the accounts payable is related to EBITDA. It's not an easy question. I hate that question. Asset retirement obligations. Should we call that debt? These are things where you screw up a mountain and you mess up the environment and then you have to fix it at the end. You'll probably run away or declare bankruptcy. Peabody Coal, declared bankruptcy today, I think, or something. You run away before you make these obligations, but if you don't, you're supposed to pay them. Should that be like accounts payable related to EBITDA? Well, it's part of your ongoing business. Or should it be debt? What a horrible question. And then Standard & Poor's says, we treat AROs, of course they have to call them AROs, like debt obligations. Although everyone could. Okay, how do we do this? Probably not a complete answer. Now, if you had EBITDA and every single year you were paying money to clean up those things, then EBITDA would be reduced for the accounts receivable, asset retirements. If it's not, then we don't. So that's probably why we do it. They say treat us debt, so we'll treat them as debt. Now, deferred taxes. Let's just go through deferred taxes and understand first, accumulated deferred taxes is different than regular deferred taxes. Accumulated taxes has an opening and closing balance. Deferred taxes on the cash flow statement on the profit is not called accumulated deferred taxes. The idea of deferred taxes is you take a deduction today, which is not the same deduction you take on your financial reports, and then you have to repay it later. You can have an asset when you pay more today, a liability when you're going to have to pay more in the future. Pay more today, less in the future. Pay less today, more in the future. Asset, savings in the future, liability, costs in the future. Okay? And here are some deferred taxes related to all of these things. And I love deferred taxes, don't you? You can look at all these things and try to figure out. Some of these are related to stock compensation. I guess what, they don't have to pay taxes on their stocks or something when you pay them in stocks, because you call that an expense and you don't have to, you book it as an expense, but they don't have to pay it. This is the biggest one, that's depreciation, and they have related to things like, I hope, derivatives. Do they have derivatives here? Asset retirement obligations that we talked, derivative instruments. If you book an income from a derivative instrument, I don't think on your taxes you'd ever show that. That's why these all occur. Just look at this and try to figure out what they all are. Okay, and then we'll go through a simple example first. This is kind of the thing we've been doing all along. We have just one asset, revenues, and on our books we take it over 6 years, taxes 3 years, 30% tax rate. We pay a lot lower taxes now, higher taxes in the future because of this is our taxes. But on our income statement we use the 30. So our EBIT stays the same. Our taxes we report are always 21. They're not 40 or 12 rather, or 30. They're always 21. Taxes paid are 12, but then they go up to 30. So we put a tax to, what we do is we say where our total taxes, of which this is the paid, or we call that current taxes, this is the deferred, you don't pay, and then you accumulate that with an opening and balance, closing balance, like you do every other time. Okay? And then the key question is, do they ever really get paid? And if CapEx continue to grow, then deferred taxes are continuing to grow too. Deferred taxes are related to the EBITDA if they're depreciation, if they're things like related to the fair value of derivatives, they're not. How confusing is that? This is not as simple as I said it was, is it? And it's not that stupid accounting. It's the figuring out the accounting, which is the hard part. And then you can have deferred taxes on an operating loss. So here we have a big operating loss. And what happens here is we don't pay any taxes, but we book our negative taxes. So this is an asset because we pay more taxes today and less in the future because we have a carry forward. Okay, so it's never paid. These deferred taxes are never paid. I said it's not like repaying debt, but that's kind of wrong because you never really repay the debt either. The better answer, it's related to EBITDA. Okay, and then if you grow, it's the same kind of thing. This is just like our CapEx where we put retirements in and we have 10 years of asset book life, 5 years of asset life, and you can show, I didn't show it, did I? But this liability continues to go. It even stabilizes, just like depreciation, stabilizes. To really understand when growth changes, deferred taxes change, it's a tricky business. That's what you need to understand in valuation. If you don't understand how deferred taxes really work. How in the heck can you explain what the deferred tax adjustment should be in the free cash flow and all that? These people in Korea were right. I sucked. Now, let's try to look at the cash flow statement just a little bit. And remember, why can't we just use the cash flow statement? They add back the stock compensation, they have net gains on sales, they have losses on investments. Rule number one, which I violate all the time. Rule number one, don't be afraid to look at this crap. Take your time. Try to figure out what it's really mean. If you can understand every little line here, then you're ready to really do some better financial analysis. Figure out why the bankers made subprime loans and stuff like that. So here's the Samsung case. They had all this other stuff. They changed their reporting, unfortunately. They added back depreciation, deferred. They had a provision for bad debts. What do we do with that? Foreign currency translation, gain or loss on equity methods. We're going to have to address all this crap. Here's how they report it nowadays. They have the same thing, but you have to look in the notes to get it. It's mainly gains on losses on different types of property, and how do we deal with that? So a gain on a loss. I'm going to do this, and then I'm going to stop for a little while. Got to take a break. I got to go have breakfast. Okay. And I don't know why I put 2 bullets here. Well, I shouldn't have put the bullets. My PowerPoint style is not very good, right? Sorry about that. Well, when we take when we sell an asset, we're taking an asset off the balance sheet, we're getting some cash. We're like transferring the asset. But if we get more than what's on the books, then we get a gain. If we get less than what's on the books, we get a loss. So we got to figure out how much is on our books and how much we're getting. And the difference is a gain or loss. The total amount we're getting is the cash flow. Income statement, gain or loss. That doesn't mean how much you're getting for the asset. That's just how much more you have than the book value. And we got to dissect this all out and figure out really what they actually got for the cash flow. So here's an example. You have this is that lady in Thailand who had the pot. Better business than mine, I'm sure. And this is how much she's making a gain. You take how much is on your books, you sell it, and you get 12. And net income includes the gain, so you take out 30, the gain out of the net income, and you see how much you're getting from really continuing operations. And here's what Standard & Poor's says. It aims to core operating activities. Any income statement. Oh, God, this one. Any income statement whose effects will be classified as operating, excluding interest included. Any income statements whose effect on the cash flows are investing is excluded. God, is that confusing? Oh, God. Okay, so this is what I try to have people do. It's a little exercise where you go through and you figure out what the EBITDA is, and you have all the impairments, gains and losses. You take the gains and losses out, and you can either take the direct method, which you take cash expenses and add back the others, but you don't include the gains and losses on sales, and you don't include any, in this case, you don't include any income. And I'm going to stop before I get to other comprehensive income. I'm going to go have a coffee and relax a little bit. Get ready for class in the Philippines, Pakistan. Okay, so that's part 2.